A little history lesson on what led to the development of this course. I've been known around the online trading community since 2010 when I co-founded a dojo of sorts called the Discovery Trading Group. Just prior to that, a friend of ours named Trevor Harnett asked me to do a webinar series for his software company, MarketDelta, showing how one might integrate tape reading skills into a complete trading process. Trevor's known for inventing the first ever plotting of tape history into wide price bars, which he called footprint charts, now a ubiquitous term. Since the presentation was one of the first, if not the first time anyone ever discussed these concepts online, the response was overwhelming, to say the least, and was the catalyst for our previously private forum being made public. From those initial humble beginnings of tape history charts, aka footprints, the depth and breadth of order flow-based tools has since exploded into progressively more granular info to include every conceivable detail of both printed trades at price and resting order book information. But with this explosion in available data and order flow analysis tools becoming almost a standard in the industry, we've watched an interesting phenomenon progressively unfold in the forum over the last decade or so. And that's been more and more aspiring traders admitting to being overwhelmed by the prospect of reading order flow information live, tick by tick, and making trading decisions directly from the dome. Make no mistake, most are still very much interested in incorporating order flow, but for whatever reason, they just aren't cut out for that level of concentration and are more interested in incorporating these metrics as part of a more simple, rules-based process. Many may be aware I co-founded a quant research firm in 2009. My partner and I have theorized, coded, and back-tested literally hundreds of rules-based single-market intraday models. I can tell you that regardless of market, strategy, or periodicity specifics, we've never encountered a fixed risk, fixed target, purely mechanical red light, green light process, as we call it, which has been consistently profitable with reasonable drawdowns through the huge range of varied market conditions of the last several decades. Many systems may work for months or even years if curve fit to current conditions, and those conditions last. But sooner or later, without risk and context adaptation, they all eventually falter. Listen, if you have something that works, but then an event like the financial crisis in 2008 happens, and you're not able to withstand and or adapt to it without blowing up, sorry, in my book, it's just not good enough. The bottom line, if you're not spreading your risk out over multiple markets, strategies, and or periodicities, you're not getting the non-correlative benefits which aid in smoothing out your performance series and mitigating drawdowns. The point being, if you're going to trade a single market intraday, you need to stop looking for the one best set of entry criteria in a vacuum and learn to start focusing on the relationship between risk and reward and how they interact with your entry criteria to produce various results. Trading or investing, for that matter, is betting on an absolutely unknown outcome, event by event, and not just in terms of direction, but magnitude as well. No static analysis of what is right now, including order flow, can universally predict what the market will be doing X minutes, seconds, or even ticks from now. In addition, your edge, should you find one, won't manifest trade by trade, but rather over groups of occurrences. In other words, trading is gambling. So to be successful, you need to start thinking more like a casino manager and not like some player trying to figure out how to beat the game a hand at a time. So with that, our goal with this course is not just to teach a viable framework for trade identification incorporating order flow, but also how to vary and or adapt that criteria as market context changes, even trade by trade. Arguably the most important part of this course is teaching you how to construct and test various risk model variants and evaluate them against different entry criteria specifics to find out which combinations produce the highest return and or smoothest drawdown curve over time. The idea being to discover which combinations are most palatable for your own individual risk tolerance and objectives. At the end of the day, if you can't stand to trade it, it doesn't matter how much money it makes. While the course framework does have its own very simple order flow analysis components, all criteria are completely modular and can be further adapted in countless ways. For example, if you decide in the future you'd like to incorporate tick-by-tick reading of real-time changes in the book and tape into your final entry criteria, perhaps to add to your edge in some way, you can easily overlay those skills on top of the existing course framework. The point being, once again, the course isn't teaching a system, but rather a framework from which you can develop your own bespoke process. It should also be noted that while the course materials use the ES market for illustration, simply because more intraday futures traders trade that market than any other, with minor adaptations, the concepts are all easily transferable to any liquid market you may choose to trade now or in the future. So in closing, who is this course for, ideally? First and foremost, any intermediate to experienced futures trader who's had enough method hunting, bouncing from minute detail to minute detail in search of the proverbial better mousetrap. The course is also ideal for the growing subset of short-term traders who are either overwhelmed by or otherwise disinterested in the prospect of watching the market tick by tick all day, trading directly from the dome. Unfortunately, many still think that's what's required in order to successfully incorporate price action and order flow into their trading, which is absolutely not the case. It's also worth mentioning that arguably the largest group of aspiring intraday futures traders currently are those pursuing the new school version of the age-old proprietary trader route. Of course, what I'm referring to are the so-called trader funding programs. The hard truth is that all of these programs have some sort of requisite performance bar, which needs to be hit in order to move on to the funded level and stop effectively paying someone to sim trade. The best way to shortcut this process, which is sadly perpetual for many, is to learn how to build your strategy and risk model in such a way which will allow you to easily mock up and evaluate various versions ahead of time. The idea being to assemble a relatively accurate hypothetical trade history to see what the performance metrics of your process are likely to look like before paying someone to sim trade it. Frankly, I'm amazed at just how many traders these days seem to be more than willing to continue to pay for these sim evaluations over and over again without having any real idea whether their chosen strategy is likely to achieve or maintain the required consistency to get funded, let alone stay funded. Teaching these efficient historic mock-up skills is one of the most important objectives of this course. And whether you learn them here or on your own, acquiring these solid model building and evaluation skills is absolutely critical, especially for anyone seeking funding from any prop firm with relatively rigid performance requirements. If either one of these categories describes you, I'm confident in saying this course will give you all that you'll ever need to stop searching and just get trading. And most importantly, being able to continue on the same basic path even as markets inevitably change over time.